Welcome to this month's XPS Investment Update, keeping you informed of key developments and how they may affect your scheme. Government borrowing in December was £27.4 billion, and the Office for National Statistics estimates that the cost of household energy bill support added £7 billion to December borrowing alone. The Bank of England Governor Andrew Bailey was optimistic on inflation falling over the year to come, but added that the bank was not trying to change market expectations that interest rates will peak at 4.5%. The bank has lowered its forecast, expecting inflation will fall to 4% by the end of 2023, down from 10.5% in December 2022. On the 2nd of February, the Bank of England voted to raise the base rate by 0.5% in line with expectations. The Federal Reserve continues to maintain that the US economy can avoid a recession, raising rates by just 0.25% in early February, a move away from a more substantial increase seen in the second half of 2022. In Asia, Japanese inflation reached a 40-year high in December as the Bank of Japan came under increasing pressures to raise interest rates. China's economic growth over 2022 was 2.5% below the government's 5.5% target. Annual growth was at its weakest since 1976, but was still stronger than many analysts had expected. Overall, January was a stronger month for equities and bonds. Emerging market equities kept pace with global developed equities over the month, and similar returns were achieved by UK shares. UK corporate bonds also fared well on the back of a slight fall in long-term inflation expectations and falling credit spreads. Falling long-term fixed and index-linked gilt yields saw both asset classes post strong returns. Despite positive performance from growth markets, aggregate UK DB pension scheme funding was down slightly over January, driven by rising long-term liabilities as yields fell. However, schemes remain in the surplus on a low-risk position in aggregate. That's it for this month's update. For more information, please contact us.